Hi, so you finally decided to start investing into the stock market. But when you got here, you saw that there are three major investment tools with which a beginner can start their investing journey. What are they? ETFs, mutual funds, as well as index funds. Now, what is the problem? All three of them look very similar, and you're trying to understand what is the difference between each and every one of them. In fact, that is the agenda for this video. We'll explain in very simple concepts what is the difference between a mutual fund, an index fund, as well as an ETF. And we'll get into each and every layer of these three types of investments, and we'll look at which one is the best for you. And as always, get subscribed for the most practical finance and stock market content in India. This is Ajay Ajith. Welcome to Market Feed. So first, to understand and learn about these three products, let's learn some basics. And for that, we need to understand what a mutual fund is and how it works. A mutual fund is nothing but an investment opportunity where you and other investors together pool your money, give it to an asset management company or an asset manager, who in turn invests it into stocks, equity, bonds, commodities, and whatever. So as the name suggests, a lot of people come together, they pool their money, they give it to an asset management company like SBI Mutual Fund, Axis Mutual Fund, Quant Mutual Fund, so on and so forth, who in turn invest it into stocks, bonds, commodities, etc. Right? That is simply put what a mutual fund is. Now, if you're looking into where India invests into most, it is mostly into active mutual funds. Now, I'll quickly give you the differentiation between an active mutual fund as well as a passive mutual fund. An active mutual fund is any mutual fund which has an asset manager sitting in the company and taking shots on where your money should be invested into. So, the fund manager is actively managing the fund that you're giving to them. So, they decide whether to put your money into an HDFC Bank, a Reliance, a Tata Motors, and they'll decide what proportion or what percentage of money should go into which stock. And they'll be constantly buying and selling shares from the market to make sure that they're making a return for the investment that you're giving them. Now, those are what active mutual funds are. And if you're looking at the statistics, Indians mostly prefer the active route over the passive route. But if you're looking at the trends, especially from the US market, you would see that the passive investing route is getting more and more popular there. Right? And with that reason, you should definitely be looking into passive mutual funds. And under the passive mutual fund section, we have two hidden entities here. Who are they? ETFs as well as index funds. Yes, the very people we are here to discuss about, they are hiding under the passive mutual fund section. So we'll quickly get into that. Now in the passive mutual fund route, the building blocks remain the same. What are they? A lot of people come together, they pool their money and they give it to an asset management company. Till there, everything is the same. But the key difference here is that there is no asset manager who is sitting and taking shots or telling that, hey, invest in Reliance, invest in HDFC Bank, time to reduce your investment there. So it is all passive as the name suggests. So how does that work? Instead of a person or a research team sitting and saying that where to invest, here the passive mutual funds often track an index. Right? They either often track an index or they track or buy another mutual fund. And that is where you need to understand the three different types of passive mutual funds in India. The first one is index funds, the second one is ETF, and the third one is fund of funds. Now, for the sake of staying true to this video's title, we'll be only looking at index funds as well as ETFs. We'll not be getting into fund of funds. In order to learn more about them, you can go check out my video that I did on US investing, where you can learn the concept of fund of funds in detail. So first, let's look at index funds. These are nothing but passive mutual funds which track the performance of an index. For example, the Nifty 50 index. So there is no fund manager here taking the shots. Instead, it is just the mutual fund which is tracking or putting money into Nifty 50. So according to the Nifty 50 calculations, if it says that HDFC Bank has a 11.2% weightage, automatically 11.2% of the fund from this index fund will flow into that stock. So what will happen here? At the end of a year, the index fund will very closely track what the index is doing. That is, if you are investing into a Nifty 50 index fund, it will closely resemble the gains you would have gotten or seen by investing directly into Nifty, right? Or Nifty 50 stocks in the exact proportion. Now to get into the next category, which is ETF, it is nothing but an index fund which is traded in the exchange, right? It can be bought and sold just like you can buy or sell shares in the Indian stock market. So one thing that you have to understand here, in India, most ETFs that you see are coming under the passive investing route or the passive mutual fund route. Yes, there are other ETFs across the world, especially in the US, where there are few active ETFs as well. But no, we are not going to discuss about that. In India, most ETFs are in the passive route, so let's keep it here. So just like you saw with the index funds category, even in the ETFs, you will find multiple popular ETFs like Nifty Bs, Junior Bs, Infra Bs, IT Bs, Bank Bs, and so on, which closely track the indices of which I mentioned, right? Nifty Bs tracks Nifty 50, IT Bs tracks the IT index, Bank Bs tracks the Bank Nifty, so on and so forth, right? So these are also mostly index funds, but the only classification or differentiation here is they are transactable, or you can buy and sell them in the exchange. So now you understood the definitions and what exactly is the difference between mutual fund, index fund as well as ETF. Right? So now let's get into a table where we can easily compare what the key differences between each are and see what is the best for you, either as a beginner, as an intermediate investor, or even as an advanced investor. Let's get into that. So first we'll get into a general comparison between each of them. Then we'll also get into liquidity and trading and also into experience level, or how you should think of it from an advanced traders or advanced investors perspective. So first, when you're looking at the management style, that's a key differentiation. In India, what we call mutual funds are mostly active in nature. Index funds as well as ETFs are passive in nature. Now, when we get into the next point, which is returns, you have to understand that in India, most mutual funds fail to outperform their indices or their benchmark indices. And out of all the categories, large cap mutual funds were the worst affected, meaning they were most probable, right? If you put money into a large cap index, it was highly probable that it won't beat their benchmark index. Right? So that's what we saw here. So returns for a mutual fund, we'll have to give it a lower rating compared to an index fund as well as an ETF, which both have a similar investing style, which are passive investing. And now let's get into the third point, which actually makes sense when you consider the return factor as well. The expense ratio. So when you're looking at the expense ratio, you can see that mutual funds often charge an expense ratio of between 1 to 2% of whatever capital you have deployed. Index funds generally charge 0.1 to 0.5%, and ETFs are usually very, very low cost and come anywhere between 0.01% to 0.1%. What does this mean? If you're trying to link this to a previous returns point, you can make the simple connection that why should I give 1 to 2% of my capital every single year to a mutual fund manager who can't even beat the index? That's a very good question that you should definitely keep in mind towards the end of the video. Now, let's get into the next part of the video, which is liquidity and trading. So you have to understand first that the liquidity is different for each of these instruments. For a mutual fund, you can withdraw at any time that you want. The fund manager or the asset management company will take care of your fund with all their heart, right? So they'll give you or help you redeem your units anytime that you want. In the case of an index fund, it remains the same. But in the case of an ETF, there are some market forces that come into play here. Now, at some level, you have to understand that ETFs operate like a share in the market, right? What does that mean? There is a buyer as well as a seller, and you're transacting between each other. So there will be a bid-ask spread, right? There will be a difference between what the buyer is willing to buy it for and what the seller is willing to sell it for, as well as what if there are no buyers when you're trying to sell your Nifty Bs, right? So there is that general concern, but ETFs, at least the major ETFs in India, are highly liquid. When you go to certain smaller ETFs or maybe debt ETFs, yes, there are debt ETFs as well. Now, when you get out of the top 5 ETFs in India, you might see liquidity is not as much as you hope for, right? So that's something to be noted here. So even that bid-ask spread over multiple months of transaction or years of transaction, it might catch up to you with small charges here and there. Now comes the question of allocation, and this is very, very important. So mutual fund as well as index fund, they are calculated by the end of the day net asset value, right? You cannot catch intraday movements here, but in the case of an ETF, you can catch real-time NAV. That means if Nifty falls 2% intraday, you can try to time the market and you can try to buy the ETF at the low of the day. Right? That's something which is very, very interesting and only unique to an ETF. Now, that's where the next thing comes in. Trading ability. You can't generally trade a mutual fund or an index fund, especially intraday, but an ETF, you can do that. You can take intraday trades in an ETF and that is very, very useful. But you'll also have to keep in charge DP charges as well as other exchange charges. So when you're coming into a mutual fund as well as an index fund, there are no additional charges or no hidden charges. But when you're going to buy an ETF, you'll notice that you're paying brokerage charges, you're paying STT, you're paying exchange turnover tax, right? A lot of other charges will also come into play. From what I understand, if you're using a discount broker, these charges will come to 0.1 to 0.15% of your transactions if you're doing a buy as well as a sell position. In fact, that makes ETF as well as an index fund very similar in their costing structure. So make sure you have that in mind. Now, the next point might also be important for you to buy a mutual fund as well as an index fund. You don't need a broker's account. You don't need a demat account. You just need a mutual fund account with the AMC, or you can use platforms like Grow, right? Which have very minimal KYC processes. But in order to buy a ETF, you'll have to get a trading account. Again, there are certain costs associated with a trading account. If you're not otherwise an active trader, you don't necessarily need to get into an ETF investment style. So now I know you've learned a lot of points. So let's come into the conclusion of the video, which is experience level and what is best for whom. Right? So the first thing that you have to understand this SIP setting up, right? Because as long-term investors, most people are looking to set up SIPs and then forget about it. So mutual funds as well as index funds, it is very easy to set up an SIP, whereas ETFs, it is manual. It is more difficult to set up an SIP. You might be getting ideas in your head where I'm going with this, or you might be forming opinions based on your investment style here. That is okay. Now, the next thing is for traders. You might see that while pledging, right, you can pledge and trade using either of the three, right? When you're pledging and trading, you might see a haircut of 10 to 20% on a mutual fund. That is slightly higher. It will be lower on an index fund. It might be even lower on an ETF. Right? So that's where haircut comes in. Make sure you keep this in mind if you're a trader. Now comes the question of who should invest where, right? So then we can see that mutual funds are usually to be preferred by mid-cap as well as small-cap investors, or for your mid-cap and small-cap investment. Why does that logic apply here? With the earlier study that we quoted, we said that large-cap mutual funds often tend to underperform their indices, but that number is better for mid-cap as well as small-cap funds. There, the fund managers are able to beat their indices much more reliably. Right? So you can think about investing into mutual funds only if you're a mid-cap as well as small-cap investor. And if you're getting into the last segment here, which is who is it best for? In my opinion, I would say mutual funds as well as index funds, it is best for beginners. Right? If you know nothing about the market, if you're just starting to invest, definitely do prefer mutual funds as well as index funds. And in these, personally, I would prefer index funds more. And when you're getting into the next category, if you're an advanced investor or if you're a medium level investor, especially if you want to catch certain opportunities in the market where the market dips intraday, right? You're a trader, anything. All of those people should be considering ETF investing. So that's the end of the comparison here. Coming into the conclusion, hope you understood very clearly what is the difference between a mutual fund, an index fund, as well as an ETF. Right? Also hope that you understood who should be choosing what in their investment journey. So if that is clear, make sure you hit the like button and you subscribe to the channel as well for more such informative videos. This is Ajay Ajith signing off. See you all in another video. Bye bye.